Welcome to the Smart Money Tracker introductory video series. In these videos, you will learn smart money strategies of the wealthy in today's market. I'm your host, Brian Netzel. Here's our disclaimer. This presentation is educational in nature and is not a solicitation to offer, buy, or sell securities. It is intended for educational purposes only and is not a guarantee of earnings or profits, as individual effort and circumstances greatly influence the profitability of any financial endeavor. We are not financial advisors or tax advisors and do not practice law. For financial, tax, or legal advice, one should seek the counsel of a licensed professional. In the last video, we learned that many Americans are not financially prepared because they are allowing others to take care of their economic future. In this video, I want to show you 4 economic trends that will affect every American. By knowing what they are, you are better prepared to protect yourself, your savings, and your future. I want you to think about how they affect your current plan toward financial freedom and what adjustments you need to make to account for them. Knowing these 4 economic trends will help you protect what you have now and build toward tomorrow. The first economic trend is higher taxes and the redistribution of wealth. Hyperinflation. Political influences on the economy, and lastly, lack of confidence in Wall Street. These are the 4 economic trends that I'd like to show you. Well, first of all, we're going to have to be increasingly dealing with the reality of higher taxes and the redistribution of wealth. Higher taxes are coming for the middle class. There are $15 trillion in assets in 401ks, traditional IRAs, and other defined contribution plans. Although the government allowed the money to be invested tax-free, you know they're trying to figure out a way to get their hands on the money. We have to account for the reality that it's going to be heavily taxed when it comes out. The savers of our country have been making 0% on their money because the stock market has been flat over the last 10 years. And then the government is going to tax it when it's pulled out. Ever since ERISA plans started in 1974, customers have been told that they could almost invest and forget while their money would grow over the years. This worked well in an economy that was increasing in value. Many investment advisors had never seen a down market until now. Much money today is not growing as it was in the past and will be taxed at a higher rate than when it was put in. Conclusion: our financial future will be taxed at a higher rate than today, further eroding our savings. Trend 2: hyperinflation. You may have suspected that our government is printing trillions of dollars in new currency. The alternative media is reporting on it. The government is printing money to pay for its debts. Some have said that the Federal Reserve knows how interconnected all the world's economies are in our day and wants to save foreign economies so they don't take down the U.S. economy. You have seen Greece in the news on the brink of bankruptcy. This type of event is unprecedented, especially since it's Western Europe. The result will be greater inflation in the future. The fuse has been lit and it's just a matter of time before the bomb goes off. We are already seeing greater inflation in food prices and many other sectors. Some experts are saying that the U.S. economy is trying to inflate assets to show improvement, to inflate their way out of debt. When a loaf of bread costs more, there is more tax collected on its sale. Trend 3: political influences on the economy. The Federal Reserve has kept rates low for 10 years and signaled they will remain low until at least 2015. This leaves people few choices of where to put their money because the bond market is not attractive with such low rates. The government has no incentive to raise Treasury rates because if they do, the cost of money is higher and it makes it harder to pay their bills. This puts people at risk by leaving little option other than staying in the stock market. Most people are torn between putting their savings under their mattress and keeping it in low interest accounts. If one looks at the overall events of the world, there are dangers abroad that can affect the U.S. economy. Since the global banking industry is so interconnected, military events in Israel, Iran, and North Korea, or financial events with Italy, Greece, and all of Western Europe can now affect our government's ability to protect our markets and your savings. You remember the downgrade of U.S. Treasuries to AA from AAA in 2011. The U.S. economy is very dependent on the world market buying U.S. Treasuries to pay its bills. If the world market stopped buying our bonds, the U.S. government would not have enough money to pay its bills. The government has no incentive to raise bond rates, or it would have to pay out more interest to foreign bond investors. There are also huge demographic changes happening right now. There are 45,000 people retiring and going on Social Security on a daily basis. The government has no Social Security funds set aside to pay out benefits, so it must take from the general fund. With such financial obligations, it cannot afford to raise bond rates, the last destination for many people's retirement funds when the stock market is flat. Conclusion: we cannot blindly count on the standard markets to grow wealth when rates of return are at historic lows and global events threaten. Trend 4. Lack of confidence in Wall Street. In the past, investment bankers respected the separation between client money and a brokerage firm's cash investments for its own operations, as the law dictates. Client money is required by law to be held separately from a brokerage firm's cash in order to protect investors in case a firm fails. The October 2011 event of MF Global sent shockwaves when company officials used customer funds to cover an overdraft. The fund was used by farmers, ranchers, and small business owners to reduce their risks in an industry vulnerable to swings in oil, corn, and other commodity prices. Imagine waking up one morning to discover that your 401k was wiped out because the brokerage had used it to cover their overdrafts. When Chase Bank in May of 2012 reportedly lost $2 billion in risky trades and derivatives, it was hardly reassuring to hear that they lost the bank's money, not client money. You might recall Bernie Madoff. What was the lesson? The bottom line was that many people were over-invested with his fund, and they accepted vague answers to their questions. Can you afford to do the same? Some of these people lost their entire savings and are now re-entering the workforce with low-paying jobs. Wall Street has lost the confidence of many people because of risky trades, huge losses, and dishonest fund managers. Conclusion: we cannot place unqualified trust in Wall Street to take care of our savings. In this video, you have learned 4 economic trends over which we do not have control that we must account for in our financial plan. In this video series, you will continue to get valuable information that helps you take charge of your financial future. The purpose of the Smart Money Tracker is to provide timely market and investment information that equips our members to match the best strategies of wealth generation that exist today. If you would like to match the best wealth building strategies that exist today, visit our website. Or if you're not yet a registered member, we invite you to join to receive full access to our resources, including the full version of our Smart Money Strategies e-course, member forum, resources, vendor directory, case studies, and more. Go to thesmartmoneytracker.com. Until next time, this is Brian Netzel.